Hello traders, Gary Wagner here, just about 10:45 in Hawaii, 3:45 in New York on Tuesday, March the 8th, 2016. We're looking at the Dow Jones Industrial Average under some pressure today, off about 87 points on the day, below 17,000 though, at 16,986. It's traded to a low of 21 and the high has been 17,072. That of course affects our S&P trade, which currently is looking at 1980, putting it off about 19 points on the day. Now, if you recall from yesterday's show, I did make a suggestion to actually go in and tighten stops from where they were, which was below 1965 to just below 1984.50, so call it 1984, 1983. For those that moved stops or tightened those stops up today, you were stopped out, and you were stopped out in a profit. You got in roughly at 1979, out at 83. So you picked up about 4 points on the trade. Not a tremendous profit, but not a loss nonetheless. For traders that are looking at more of the big picture or the larger move, stops below 65 are still holding, obviously, with the markets low at around 75 to 77 in that area. So traders, on today's show, I kind of want to qualify why I suggested that you tighten stops and really what we're looking for in the very near future. Now, obviously, we saw something that concerned us in terms of this upward momentum that we're witnessing in U.S. equities, along with, of course, the Standard & Poor's 500. Now, oil is down. It's down for the first time in quite a few days. Tremendous rise in oil, and that has been supportive of the market. We're well above our 50-day moving average, but below our 200-day moving average. So we're right within this zone here between the 50 and 200. However, also is the fact that we've identified a key level of potential resistance, and I believe it's more than a potential, seeing what we're witnessing today at roughly 2003 on the Standard & Poor's 500. Now, that particular price point is derived from this fib retracement from the August meltdown of these recent highs here at around 21.09 on the high to these lows here at about 1831. And when we do that, we have a couple of key areas that we want to look at. 61% retracement is one of them. Of course, the second one obviously is our 38% retracement level. Now, as this market moved up, and I want to kind of go ahead and widen up this chart just a little bit, but as this market made its dramatic climb, we saw that it had one real nice move from these historical lows that we had, the lowest that it's been this year. And as the market came up, we saw it run into some real resistance roughly in the area of the 61% retracement, which is, of course, 1933. It managed to take that out and take that out with a vengeance. You look at this particular day of trading, I believe that was a 300 point plus day. But since then, you've really seen the body size on these last 4 trading days diminishing, contracting, getting smaller. And the distance between where it opened and closed, although it closed higher than the open, the key, as far as I was concerned, is the net gain continually got smaller and smaller. Now, you can really see this on our regular candlestick charts. It's also very apparent when we pull up a Japanese average chart. But this diminishing body size and the fact yesterday that we closed at but not above this price point here of about 2,000. I moved this slightly a little bit, so I'll have to kind of recalibrate it after the show. But once we couldn't get that close above 2,000, that told me that we might in fact see some real resistance on a technical basis and see this market kind of sell off a little bit. We saw just that, and that was the primary reason for recommending that you could in fact go ahead and trail those stops up and make some profits. For those that are still long, our stops are below 65 on that. We're looking for the bigger move. We're willing to stand the chance that this market does come down a little bit, but doesn't stop us out. This being 66 right here. So comes down a little bit, doesn't stop us out, and does make that splurge or that cascading move up past the 200-day moving average. Of course, there's more risk in that, so obviously there is more potential reward. And so lastly, traders, I've just brought in another chart, but this has got the same fib retracement, but it is in Japanese average format. And you can see the differential. The body size obviously didn't look as small because we drew it compared to the midpoint of the prior candle, but they were diminishing. But take a look at today's candle. Now, on a standard candlestick chart, we've gone red, but because we're comparing it to the midpoint of the prior day, if you look at this particular one, you get that telltale sign, that doji, and that doji can definitely be the first indicator of a key reversal in the market, that pivot point. And it tells me that there is a likelihood that we will see a little bit more downside before we see upside. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.